Good morning, well fam. This is not your typical full video, just something short that I wanted to drop. So after the last video that we dropped, I got a lot of questions, especially around treasury bills and mutual funds. I understand because they are similar, but sometimes it could be dicey deciding which one to invest in. So that's the purpose of which I'm making this video. And I will start by the definition that I gave again the first time. Treasury bills are basically a way to lend money to the government. So basically, you're borrowing money to the government and they're going to pay you back at a certain date. However, the way that it is structured is that there are different tenures for treasury bills. So there's a 90 days, 180 days, 365 days, like that. And that determines the return that you get. Now, with mutual funds, is a pool of funds put together by an investment house, Stanbic Ibtc, for example. They pull the funds together and they invest them in a number of things. Now, the specific mutual funds that we're talking about in this case, that is similar to treasury bills, is the money market mutual funds. And what makes it similar to treasury bills is because the investment house that pulls the money together invests a huge percentage of it in treasury bills and some additional things. So they look similar because the moment you invest a ton of it in treasury bills, it means that the returns on those mutual funds and on treasury bills are going to be similar. So that is the thing that makes them similar. Now, what makes them different? For a treasury bill, because you buy an exact investment. So, for example, today I invest in a 90-day treasury bills. That is one chunk of investment. If tomorrow or next week I have another money, I need to buy another treasury bill, basically do another bucket of investment. Now, stay with me. So you're investing, maybe so today you have to maybe call it bill A, tomorrow bill B, and that the one you did last week could be a 90 days one, and next week you have another money, you can do a 180 days one or a 365 days one. What that means is that the time to maturity is going to be different. Maybe we're in January. If you do 190 days one, that one will invest, that one would be due in March. Then maybe in February you do another 6 months one, then that one will be due in July. Then in June, you had another money. You do another 365 days one. That one would be due the next year. So it's really different investment every time that you want to do an investment. However, with mutual funds, it operates like a savings account. And I will explain what I mean by it operates like a savings account. Back to our example, if you had 50,000 today and you put it in a mutual fund, they open one account for you and they call it your money market mutual fund. They call it your investment account. You put 50,000 there today. If in June you have another 100,000, you're going to just top it up to that same account. And the reason why they can do that is because they don't calculate the return based on the tenure or whatever. The return is calculated on a daily basis. So the day you put 50,000, they start calculating your return every day based on 50,000. Another day you have 100,000, you add it to the same account. Then they start calculating your return from that day based on 150. And then they pay you at the end of the month. For the money market mutual fund, your interest is accrued every day, but then it's paid at the end of every month. So the way that I see it is that, especially if you feel like you want to do this at a continuous or a rolling investment where you have some money today, you're going to have another money next month, you're going to have another money next month. Doing a money market mutual fund makes it easier for you to manage because now you don't have to remember when your investment is going to mature, right? Because really you can top it up every other time that you have additional money. And the difference also in the maturity period is that our mutual money market mutual funds that have a minimum holding period of I think 60 or 90 days. I will check and put that on the description. So it's 60 or 90 days. What that means is that the day you started the investment, which was the day you put the first 50,000, count 90 days after that. If you need money, you can then withdraw from it. You can withdraw from it, and when you withdraw from it, what it just means that they start calculating your interest based on what is left after you withdraw. That's what it's similar to a savings account, but with better returns. Also, I think the other difference is when you withdraw from it, you take about 24 hours. But it's not like a savings account that you can just withdraw and get the money. It takes like 24 hours for the money to drop. But that's really it. However, for the other difference is also that with treasury bills, because the day you buy the bill, your interest is locked in. First of all, you get the interest upfront. Get the interest the day you buy the treasury bill. And then you get your capital back at the end of the 90 days or 180 days. But also your interest is locked in. So if the interest rate is 18% on the day you buy a 1 year treasury bill, for example, you collect your 18% that day. So it doesn't matter if down the line the interest drops or the interest goes up. That interest rate, you're locked in on that interest rate. However, with mutual funds, because again, like I said, your interest is calculated every day. So what that means is that if today interest rate is 18%, they calculate your interest for today based on 18%. They accrue it somewhere. If tomorrow the interest drops to 14%, your interest for tomorrow is calculated as 14%. And then like that, and at the end of the month, you just get a sum of all of the money. So it has pros and cons, but I just think that one is easier to manage than the other one. And with the interest rates, because we both know that the rates could go up or down, so you can't really say that it's better to lock in with a treasury bill. The other good thing about a treasury bill is if you are then sure that you just have bulk money, that you're not going to have another money that you want to invest in this kind of investment in the near future, you can put it in a treasury bill and just move on, especially if you feel like the rates are high and you want to lock in on that high rate. Then you can put it in a treasury bill. But yeah, those are really the, but I believe that also you can't really, sometimes you can't really predict the market. So sometimes if I have bulk money, I put it in treasury bills. But if I have small money that I want to sort of top up, I put it in a mutual fund so that I can just continue to top it up. So that's really it. The difference between mutual funds, money market mutual funds, and treasury bills. I hope that I've been able to convince you and not to convince you that both of them have their advantages, and it just depends on what you want at every point in time. Bye and see you in my next video.